Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, I closed the last show of Midweek Markets, which was about 2 weeks ago, by stating that the UK and US markets would likely gain some certainty in the next week when the Bank of England and the Fed's policy meetings occurred on the 23rd and 22nd of September, respectively. And my parting comment was that things could get interesting. Now, back then, the S&P 500 was trading at around about 4,480, but has since fallen 3%, only to recover those losses to then pull back once again and sits around about 4,350 as I make this video. So there was a real roller coaster ride. Now, in the UK, the FTSE 100 has been on its own equivalent roller coaster ride, but is around about 1% higher than the 7,000 level it was at 2 weeks ago, partly boosted by tumbling pound, which I will come on to later in this episode. Now, we've also seen similar levels of increased volatility in European, Asian, and emerging markets. So what has been going on in the last 2 weeks? Well, in truth, a number of factors have been at play. The first shockwave emanated from the Chinese property market in the shape of Evergrande. Now, Evergrande Group is China's second largest real estate developer, and in 2018 it became the world's most valuable property company. Now, Evergrande currently oversees more than 1,300 projects in almost 300 cities across China, but also boasts other business segments ranging from wealth management, electrical vehicles, food and drinks manufacturing. However, Evergrande shook bond and equity markets after it was reported to be struggling to meet the interest payments on its debts, which total a staggering $300 billion. Now, the company had previously borrowed huge sums of money to expand aggressively, but after the Chinese government clamped down on excessive borrowing by real estate companies, Evergrande is now effectively experiencing a liquidity crisis. On the 20th of September, Evergrande shares dropped 19% to hit an 11-year low, having already fallen 85% over the course of the year. Now, the global credit rating agencies have also downgraded its bonds from B+ to CC since September 2020. Now, understandably, bond markets globally sold off over fears of contagion. But it's not just a property story. Evergrande owes money to 171 domestic banks and a further 121 financial firms. And that's before you even consider the money owed to suppliers. Now, concerns began rising that this could spark a financial crisis emanating from China, perhaps another Lehman's moment. And on top of that, around about 1.5 million customers could lose deposits on unbuilt Evergrande properties if the company were to collapse. Now, while Asian equities were understandably hammered, developed world equities only pulled back between 2 and 3%. Now, obviously, there were some sector-specific nuances with property shares underperforming globally, but the market swiftly moved from fear to cautious indifference, assuming that the Chinese government would ultimately bail out or nationalize Evergrande for fear of contagion within the Chinese property sector, which currently accounts for 27% of the country's GDP. With the Chinese economy already showing signs of weakness, the government would likely go to great lengths to ensure that the Evergrande saga doesn't send the country towards recession. Having parked their concerns over Evergrande for the time being, the Western equity markets turned their attention to a swathe of central bank policy meetings, while both the US Federal Reserve and the Bank of England kept their monetary policy unchanged. An increasing number of the US Federal Reserve's policymakers now expect to raise rates in 2022, which is earlier than previously thought. And similarly, the Bank of England gave off some hawkish signals of its own. It meant that investors who were already pulling money out of bonds because of the Evergrande saga now had further reason to do so. And if you looked at the 10-year US Treasury yield over the last 2 weeks, it exploded higher, and that was to the benefit of the reflation trade assets, so financial stocks. But tech stocks, on the other hand, took a bit of a beating, and Bitcoin didn't enjoy the rally either, given that it's often seen as an inflation hedge, because China announced a complete ban on cryptocurrencies, which obviously hit the price of things like Bitcoin. Now, in the days since the Fed policy meeting, bond yields have continued to push higher and at one point hit 1.55%. Now, don't forget, when bond yields rise, their price falls. Such price moves have been replicated across government bonds globally. In the UK, the 10-year UK gilt yield hit 1%, which is actually the highest level since March 2020, when investors were panicking about the COVID pandemic. And now this has happened because investors are focusing on the energy crisis with rising gas prices and oil prices and its potential impact on inflation. Now, bond markets are set for their weakest month since early 2021, which just shows you the scale of the pullback. Now, after spending much of the last 2 months trying to make up its mind about the future course of inflation and monetary policy, it seems that the bond market has finally placed its chips on the table and is betting on higher inflation, higher interest rates, and reduced QE measures. And while equity markets have since started to stabilise and even rally since the Fed meeting as investors ditch bonds in favour of equities, the question now is, how long can such a trend continue? I mean, history shows that at some point, the rise in bond yields and tumbling bond prices will start to matter to investors, even to those reflation trades, so those sectors like financials. I mean, tech stocks are already down 4% in the last 2 weeks, and that's if you look at the NASDAQ 100, and they still look pretty vulnerable right now. Now, how long can the wider market continue higher without them participating, given that they've been these sectors that have been really driving the bull market of late? But the other thing impacting UK investors right now is the value of the pound. Now, the petrol crisis, which we all know about, queues at the pump, has shaken investors' faith in the UK economic recovery. And so the pound has tumbled 2.5% in the last 2 weeks against the dollar. But the pound has also weakened against other currencies too. And that has proved a currency boost for overseas holdings within your portfolios. And it means that it's sheltered you slightly from the worst of any bond and equity weakness that you might have seen on your overseas holdings. But keep an eye on the $1.35 and the $1.34 level, because we're down around those levels now. Because if we breach those and fall lower and hold lower, we could revisit the $1.30 level in the near future. It really is a case of, as the summer fades and the darker, blustery autumn days become more frequent, that it's almost a perfect metaphor of what's going on in investment markets right now. We're all being buffeted from pillar to post. And really, I suppose the word of warning is to be prepared to hold on to your hat. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, Money to the Masses with the number 2. We're on Instagram, TikTok, Facebook, and of course, don't forget to subscribe to our YouTube channel.